Welcome to the Salty Investors, episode number 24. It is Friday, March 17th, 2023. How are you, Tim?
Yeah, pretty good. Yourself?
Yeah, not bad on this Bailout Friday. No prizes for guessing what the salt is this week. Why don't you kick us off, Tim?
Oh, you can probably guess where I'm going to go with this, but just a
Yep.
bit salty about these rich crony capitalists. There seems to be a lot of them out there, and
Yep.
there's a lot of very rich ones as well. And they've had it good for a couple of decades, and then as soon as it turns around, it goes a little bit bad for them. For a few weeks, they're all out there asking for a handout. And they've got all their companies with their negative cash flow, free cash flow, and had a great ride for decades and decades, and then all of a sudden, they're like paupers. They've got nothing in the bank and they need a handout from taxpayers. So, yeah, it just seems a bit rich to me. What about yourself? What do you think about it?
Exactly the same. I just wanted to single out sort of Larry Summers as the avatar for the, this is not a bailout crowd. He said, this is not the time for moral hazard lectures or for lesson administering or for alarm about the political consequences of bailouts. And I say to you, Larry Summers, when is the time then? When is the time to talk about bailouts? Because we were talking about it 14, 15 years ago, and here we are at exactly the same place again. And so if not now, when, Mr. Summers?
Yeah, it's not all right in the good times. It's, not all right in the bad times. Well,
Yeah.
Yeah.
Yeah, well, something that you said about in your salt, you said that, they've had good times for what, I don't know, couple of decades.
30 years at least, yeah.
Yeah. And yeah, I mean, these people are not, look, yeah, there are some people in startups who aren't fabulously wealthy, but the investors are. I mean, you've got this idea that it's not a bailout. Look, the FDIC insures up to $250,000. Anything over that is a bailout by definition. It's a bailout. Stop pretending it isn't. Oh, they say, the stock and bond holders are zeroed out. Yeah.
And the management. Yeah.
That's what's supposed to happen. And you're also not supposed to get any money over $250,000 because, again, it's just, do you have a lot of money? You get special treatment. What it comes down to. It's what it comes down to. So plenty more to say about that. But I just wanted to get maybe the next most important thing of the week out of the way, which was the inflation report in the United States. This is a bit of a chart crime. I've got two different axes going on, but I just wanted to show, because I think, clearly the inflation peak was sort of mid last year and then it's come down, but it's not going straight down. It's not all one direction. Remember last year we had a 0.2 print in November and then 0.1 in December. Oh my God, inflation's fallen off a cliff. Now we've had 0.5 and 0.4 since then. So, it's not exactly going down a straight line. And I think, the aforementioned Larry Summers, who has been hitting it out of the park about inflation, he was quoted like, I think, less than 2 weeks ago before all this SBV stuff kicked off, SVB, he said he wouldn't be surprised to see that the Fed would have to go to 6%. Yeah. And he's not the only one saying that. Right. And my view is that this is not another financial crisis. This too shall pass, and it'll pass pretty quickly. I mean, the stock market's, flat since this thing came out? I think the NASDAQ might be up because people have said, let's get out of financials and go back into tech. Like, I think Microsoft's 270, so it's the highest it's been for months. Like Microsoft.
The S&P's up 2% in the last week. So
there you go. I mean, yeah. I guess the corollary is that's they're tiptoeing over the cliff, but I don't think so. I don't think this is systemic. So I just thought, the inflation read, there's still a little bit around. I noticed people start making arguments about whether, whatever suits their their view and they start talking about month over month. And if that doesn't suit their view, they start talking about year over year to justify their views. So,
yeah. We fall into that trap ourselves a little bit. So it's good to see both of them there. So
yeah. So yeah, I mean, we all know that housing is still a big component of that, and housing is lagged, but yeah, inflation, it's still hanging around, which is kind of what we expected. We've been saying we don't think interest rates would go down before the end of the year. Even this minor scare, to me, I don't think it's going to stop the Fed going another 25 basis points. What do you think?
Oh yeah, they're going to slap on 25 for sure here. I can't see them slowing down at all. And they've fixed it according to them. We're a bit road down the road. This obviously hasn't fixed it in reality. It's just papered it all over and more fragile. The whole system is actually more fragile. It's going to encourage more risk taking. People aren't going to. So I don't know. We're going to see what happens, but yeah, it's still looking good. I think inflation number just tells you what they're going to do, and jobs tell you as well. Like Australia, we got jobs yesterday, didn't we? Or another 65,000 or something. That's not looking good at our end. So yeah, it's definitely on, I think.
Yep. So yeah, this is hilarious. Cliff Asness, Yellen's come out and said uninsured deposits are not protected without systemic risk determination. So, I mean, that's just another way of saying too big to fail. If you're a big institution and you threaten the stability of the financial system, then you will be bailed out. If you're some idiot who started up a business in his backyard and you lost $500,000, cares. This is, I mean, what's so sad about this is that, 15 years ago with Dodd-Frank, and we're talking about banks making living wills and all these kind of things. And, here we are again. Nothing's changed. Absolutely nothing's changed. If anything, the system seems to be even more fragile, doesn't it?
Yep.
I mean, you create this situation by insuring deposits in the first place. I mean, so people take these risks, and then they can go, "Oh, bailout, please."
Yeah, it's terrible, isn't it? Oh,
it's horrible.
Gets me upset, but yeah, I know. But Cliff's, he's onto it, so I don't know. Yeah. Just never ending. But there will be a time when people are going to say, hey, we've gone, all this papering over and, trying to control it all. You won't see it. It's supposed to be, underneath it's going to be a house of sand, because we know it underneath it's, people don't really trust it. And you can see what happened over the last week or so. It's supposed to be, all the stress tests, you remember that? Oh, they were going to pass it. SVB was going to pass. It's flying colours. And then all of a sudden it's like, why is everyone moving all their money out? And then you got Bill Ackman saying, everybody's going to be moving their money out on Monday, and that's going to cause a collapse. And what's the problem? It passed all the stress tests and everything. What are you worried about? So,
well, it's like, do you remember what the culprit was 15 years ago? VAR, value at risk. This magic measurement. Value at risk, you were fine, and it didn't measure anything. It was useless. So now we've got the stress tests. Okay.
Yeah.
No.
And what's going to happen next time?
I thought
Yep.
Yeah. I thought this was interesting because it was very revealing. This was in the FT. Okay. Europe's financial regulators are furious at the handling of the Silicon Valley Bank collapse, privately accusing US authorities of tearing up a rulebook for failed banks that they helped to write. While the disapproval is yet to be conveyed in a formal setting, some of the region's top policymakers are seething over the decision to cover all deposit at SVB, fearing it will undermine a globally agreed regime. I love this quote. One senior Eurozone official described their shock at the total and utter incompetence of US authorities, particularly after a decade and a half long and boring meetings with Americans advocating an end to bailouts. Yeah, I mean, well said. You fucking hypocrites.
Yeah. But what are all these regulators doing? I know I've got a job and things to do, and I'm not watching all these things. All these guys are doing it, they're supposed to be their job.
That's their job.
And they still miss it. They still miss everything. So I know it's like, when are you going to keep trusting all these people to, that they can really do their job? And then taxpayers end up fooking the bill anyway. So,
Yep.
mm,
Yep. So then, I don't know if you heard about First Republic
a little
Bank.
bit. Oh, yeah, it's
Yeah.
a nightmare.
So
Yeah.
today, or sort of yesterday, US time, it looks like 11 major banks have chipped in $30 billion. So this is a private market solution. Sounds all right. I actually couldn't read that article because it was behind a paywall. So I don't know if the banks that are putting this money have got guarantees or anything like that, but I just don't know. But see, this Diogenes, which is that's Jim Chanos on Twitter, and he says, look, there's a banking analyst on Squawk Box blaming muni bonds, which are 8% of the bank's assets, and short sellers, of course,
Yeah.
for
Demon. Yeah.
FRC's problem, not the massive fixed rate component, 64% of assets of their loan portfolio. But again, this is basic duration mismatch. You know, you've got 64%, because actually, if you look down the bottom of that chart, it says only 37% of their assets are fixed rate. But if you're reading the fine print up here, those hybrids, the majority of the hybrids are fixed between 1 and 10 years. So that's what it says up there in the fine print. Number 2, hybrid rate loans for which the initial rate is fixed for a period from 1 year to as many as 10 years, and thereafter the rate becomes adjustable. So, yeah, most of those, so it's again, this is basic. And he said elsewhere in another tweet, I mean, the bailout of SVB doesn't do anything to address the underlying problem of duration mismatch. These people have borrowed. They borrow short, they lend long, they've invested long, and of course they're paying nothing for the depositors, and the depositors go, I'm out of here, en masse.
The question I've got,
game over.
We've had these rising interest rates for a year, okay? Why has it only come out in the last week, all this stuff? Like, why are they only collapsed in the last week? What's happened 6 months ago? Why? Like, surely when it went up to 2%, from zero, that would cause a fair bit of stress. If I was the credit manager there, I'd be like losing my mind. Like, because you've still got the same problem. So,
as was pointed out during the week, I think the credit manager's too busy engaged in diversity, equity, inclusion programs, to actually be doing her actual job. So these people don't know what they're doing. Who knows? I don't know what these people
do for a job.
Do to get qualified to be so-called credit risk. I mean, this is the thing you're supposed to be. That's why you're there, to stop this sort of thing happening.
That's why they give you money at the end of the week. Surely, not to go to meetings and look after the birthday party and all that sort of crap at work. Surely you've actually
make
got
sure we have. Well, she was busy making sure they had Pride Month and whatever diversity training and insane how these people. And anyway, she'll go off to some other couple of $100,000 job a year somewhere else, I'm sure.
Yep. And we pick up the bill. Yep. Well.
Yeah. This was just again, as this was just Chanos going, like, while everybody's celebrating the bailout, none of these policies address the fundamental duration mismatch problem that many of these financial institutions have. And he said, with few exceptions, no other financials were priced as if they were insolvent on Friday. So that he's talking about SVB, and of course then we got FRC, and the second point there, being able to borrow secured from the Fed at par rather than at market prices really only helps in a distressed situation like SVB. It doesn't address the mismatch in assets, liabilities, and over-reliance on zero-interest large deposits. Like zero-interest large deposit. It's just insane.
But how lucky are we to get to this guy? We can just read his stuff on Twitter now. We went back 20 years ago. You don't get access to this sort of stuff, right?
Well, even 15 years ago, I don't think he was on Twitter at the time. But I remember Chanos in 2009. Now, some people have forgotten why the market bottomed in March 2009. It was because the Accounting Standards Board, Financial Accounting, FASB, Financial Accounting Standards Board, went back on their insistence that banks had to mark assets to market. Chanos was all over that because it they were upset that they would have to mark these assets to market. That and they were right when they said, look, some of these assets are basically worth nothing now, but they will be worth something in the future. Some of these mortgages, they would bounce back eventually. People, and private companies did come in and buy them. But Chanos pointed out is actually the majority of bank assets don't have to be marked to market at that time. But there was this image given off that all of them did. Most of them don't. He was all over this stuff 15 years ago. That's why, as soon as this stuff happened, I went straight to see what he was to say. And I just thought this is related, which is that all these venture funds. There's this, and Cliff Asness is pretty hard on this too. He wrote something about 3 years ago about that really venture funds should have a illiquidity discount because they're illiquid, right? And they don't take marks. They don't mark to market. So they can, if we're going through a bad period, I will just suspend the mark to market stuff.
We do an in-house valuation.
Yeah, exactly.
Oh, boy.
It's a bullshit game. They should totally. I mean, they don't have to mark to market, so they don't. I mean, why would they? You can't blame them for not doing it if they don't have to. But it is a bit of a sham. So they benefit in a number of ways, and then stuff like this happens and they get bailed out. It's pretty disgraceful, really, isn't it?
Oh yeah. Oh, Tiger, eh? We're going to hear that a few more times, I'm sure, over the next 6 months. It's going to come up. So,
Well, how many of these venture funds are just they know they've just choked down. They're sitting on losses at the moment, and they just haven't marked them. And maybe someone like Tiger comes out and does it. Maybe there'll be a wave of that, and people who feel safe doing it, will come out and admit to it.
Well, if Tiger writes it down, and you're holding 10% of that fund, that company as well, surely you've got to mark it down as well. Like, you can't have different valuations flying around. Surely that's not going to fly too well. But yeah.
Anyway, I think that's all I've got. You got anything more you want to say about these cretins who don't believe in capitalism, except when things are going their way?
Yeah, nah. Everyone knows how I think about them, but it just gives power to the lefties. I'm sort of, they talk about, these guys are criminals, they're not doing the right thing, and then they come ask for handouts. This is what happens, when you're not honest and integral, and then they've got a point. You're freaking crony. So,
but where is the I mean, you had Occupy Wall Street. It was a pretty strong movement back then.
Yep.
Where is it this time around? Have they just not realized it yet because these guys don't pay attention to it?
It hasn't got to Main Street yet. Yeah, Main Street hasn't been hit as
that's
hard
probably
yet.
Why.
As soon as it will happen. If we go, a hard landing happens here, we're going to look back on this and go, well, all these other guys got bailed out. What about poor me?
Where's our bailout? Yeah.
Yeah.
Sorry, mate. Your job driving trucks is not systemically important. You're not,
your milk
not
bar.
important to the function of the financial system. Yeah,
that's right.
Exactly.
And I just hate the veiled threats from it all. The veiled threats is just so nasty. Like, if you don't bail us out, the whole place is going to implode. It just, like, you could see me, I'll just be fuming at the other end, going, oh, you reckon you're important.
But that's why, Larry Summers, it annoys me, that quote that he's now, there's not the time to talk about bailouts. It's because the people who've got a lot to lose are the ones that have got a lot to lose. And most people, like, what percentage of Americans have more than 250 grand in cash in a bank account? Not many. And if you do have more than 250 grand in cash and you're half savvy, you've probably spread it around a bunch of different banks, right? So that everything's insured.
And you probably own 5 houses and, a share portfolio.
Diversified. It's just disgrace. Absolute disgrace. Anyway, nothing changes, eh?
No.
What have we got this week, Tim? Who are we looking at?
Well, I sort of thought, been doing a few screeners. Boy, prices have
Yep.
come back down a little bit. We're sort of back about 3 years ago in Australia, a share market is equal to, so.
Yeah, someone said that the PE of the Aussie market was down to about just under 15 now.
Yeah, it's about
But
something like
of course, Australian market's weird because of the
banks.
overweight of
Fine.
banks and resources, really, isn't it?
Yeah, so you've got all heaps of low PE type multiple companies in there.
Yeah.
So, yeah. It probably should be that. It probably should be lower, to be honest.
Yeah. Yeah.
But yeah, so I'm trying to doing a few screeners, and this one popped up, and I thought, I'm trying to go into the lower market cap stuff. I'm trying to find these multiple baggers. Which is a lot harder work because you're working with names you don't know nothing about, and so I came across this one, and there's basically hardly any analysts looking at it. So that's got me sort of interested. Yeah, and I found one guy who's done a really good write-up on it, called William Houston, and he's at American Uni. He's just a senior there, and he did it for a competition. And thought he did a really good write-up, and I thought, oh well, this sort of explains it a bit for me. And yeah, so I shout out to William there. Done a really good job on it. And so this company basically they do compliance and SEC filing for companies and funds, and they also do SPACs and IPOs and M&A type paperwork for the SEC. And they're the number one in the world at this.
So they're not competing against Computershare?
No. They actually do the actual filing to create, a SPAC or, to do your 10K or
righto.
to submit all that paperwork and everything to the SEC. And
so a lot of that's legal stuff rather than
and timing. Yeah. So there's a timing factor in there as well. And if you're a different entity, you've got to do different types of paperwork. There's all these different requirements, the size of your fund or company, you got to do different types of paperwork. So it's a freaking nightmare, like you can imagine there's no way that, if you're sitting in some office, you're going, I'm going to go and try and, even if you know it, I'm just going to risk it and go myself on this, you'd have to have pretty big balls to do that. To give an example of the share, they've got like 60% of the S&P 500 that use their software, 70% of the Fortune 1000, and 80% of the 50 global fund complexes. So obviously, they're linked in with a whole heap of big funds and most big companies that use their software. So, and the thing is, it's a asset light type business. And the customers aren't really price sensitive. Like if you're JP Morgan, you're not going to be care about paying a few $1,000s a year for software that helps you comply with the SEC. They do paperwork to the SEC every week, basically. So they're not going to worry about a few bucks. And if you look at 10 years, what do you think? I think the regulations are just going to get more crazy, going to get more stringent, more onerous. So I think I can't see this, area getting easier and easier. There's not going to be a one-page form you fill in once and, off you go. This is going to get it. You can imagine after the next collapse, it's just going to be insane. And they're moving from a physical type business to a SaaS, a software type business. And there's only a couple of competitors, and you'll see in the numbers here. You can see where they've moved, what their return on invested capital in the last couple of years has just jumped, and you'll see their gross margins have really shot up. And this is because they're decreasing from a paper type business, a print type business, into a SaaS type business.
I see that. Well, I can see employee headcount's gone down. It looks like from, if you look at 2019.
So there's a few, and you can see like they're doing buybacks as well. Like they're really, hooking in a bit here as well. That's a pretty big buyback, So for some, so my catalyst is, as you can see, it's Donnelly Financial Solutions. So I think this will get thrown out if there's a financial problem, banks like we've got at the moment, I think
Yeah.
these guys will be lumped in with them and sort of sold down as well. And my evidence on that, S&P this week has gone up about 1.2%
Yep.
over the last week, and they're down 5+%. And they've been,
What's the bank index down?
I think it's down pretty badly, but I'm not sure
Yeah.
exactly. If you look at the regional one, that's been smashed, but
Yep.
not sure the major one. But yeah, my DCF comes out, 10% DCF, discount DCF comes out pretty much fair value. So
Right.
this is one of these ones that I think, this has got no coverage, got some good characteristics. The moat isn't super strong, but
Yeah.
you can see how they're adding value into the system here that people aren't going to switch out of them too quickly. I put the balance sheet and the cash flow on the next one. They've got a little bit of debt, which probably
Yep.
will, but you can see the cash flow.
It's gone down though, hasn't it? Net debt's gone from 500 mil down to less than 200.
Yeah, and you've got 100 mil a year coming in on cash flow. So
Going with yeah, cash flow. Oh yeah, 150 to 200 million cash flow, operating cash flow. Free cash flow, 100 mil. Yeah.
So they could cover it here pretty easy, and they could just stop those buybacks. I'm like, well, I'd like you to stop that a little bit, and plow it into this debt a little bit, but each to their own.
Yeah. Well, I mean, how? What did they have? I was going to say they're about what 11 times earnings. So is that historically expensive or?
No, it's pretty much in line. If you go back to, you see the PE, it's pretty much in line.
Yeah.
Yeah. So yeah, it's not too far off. So, but it's a changing model now. You're supposed to get higher multiples on these, fancy software type businesses, aren't you, Scott?
Well, I don't know. I pronounced the SaaS revolution dead a while ago. Look how many of these businesses just suck. I'm thinking about the Australian microcap SaaS businesses. I mean, this is obviously a successful one that makes money. Most of those don't. But yeah, SaaS, I think, was sort of an overrated concept there for a while. But yeah, I mean, these guys make money. No, what I was getting at is if the business model has changed and they should be trading at a higher multiple, maybe the buyback is worth doing it.
Yeah. Oh, yes. Yeah, get in while I'm just over cautious, with interest rates rising, I'm always a little bit, iffy about debt, I'm just like, oh, what happens if they keep going at 6? Holy hell. Like, they've got the cash flow to handle it, but I don't know why I'm panicking here. They're easily going to cover this. So, and they've got heaps of assets and everything. So, there's no problem. Current ratio is basically even here. So, your current liabilities, so they're miles ahead. Compared to the junk that I see being putting up elsewhere. This is, interest coverage is 20. Come on, Tim. Give it a bit of a run. So, yeah. Just another one.
Yeah. Price to cash flow 7. Yeah. All right. Well, that looks. We can add that one to the.
It's very cheap.
To the watch list
normally,
as well.
I've got nothing that cheap. Normally, like that's super cheap. Compared to. Yeah. But yeah.
Yeah. All right. There you have it, ladies and gentlemen. Donnelly Financial. That's listed on the NYSE, is it?
Yep.
Yeah.
All
right. So we'll probably leave it there for this week. Don't be too disheartened, people out there. That all your tech bro friends are getting bailed out. We're here for you. We're here for the little guy because we are the little guys. We'll see you next time.